Power on Wall Street used to be loud. It lived in glass towers and trading floors, in flashing screens and shouted orders. If you wanted to know who controlled money, you looked at banks. You looked at investment houses. You looked at places where risk was visible and ambition was obvious. But power has a habit of moving quietly. Today, the deepest pools of money in the financial system are no longer sitting inside banks. They aren't even sitting inside hedge funds. They are hiding somewhere far more boring, far more trusted, somewhere almost no one questions. They are sitting inside insurance companies. That sentence should feel wrong. Insurance is supposed to be dull, predictable, conservative. It exists to remove risk from your life, not introduce it. You don't buy insurance to make money. You buy it so you don't have to think about money when something goes wrong. For decades, life insurance fit that role perfectly. You paid a premium, actuaries ran the numbers, the company invested in safe government bonds, and decades later, a payment arrived exactly as promised. No drama, no leverage, no surprises. Insurance wasn't exciting, and that was the point. But after the 2008 financial crisis, that boring reputation became the most valuable asset in finance, because while the world was watching banks collapse, a different opportunity quietly appeared. An opportunity hiding in plain sight. When the global financial system nearly broke, regulators responded the only way they could. They tightened the rules around banks. Capital requirements went up. Stress tests became routine. Risk-taking was constrained. Banks could still operate, but the old days were over. They were no longer allowed to behave aggressively without consequences. At the same time, central banks made a different decision. They slashed interest rates to zero and kept them there. This stabilized the economy, but it created a new problem that no one wanted to talk about. Yield disappeared. If you were a retiree depending on fixed income, your savings stopped working. If you were a pension fund promising 7% returns, your math stopped adding up. If you were an institution built around safe income, you were suddenly starving, and starvation changes behavior. When returns vanish, risk starts to look reasonable. This is the environment where a different kind of financial player began to thrive: private equity. Private equity firms are not banks. Traditionally, they bought companies, restructured them, loaded them with debt, and sold them for a profit. It was a business built on ownership and leverage. But low interest rates changed the game. Lending itself became extremely profitable. Why buy a company when you could act like the bank and charge it double-digit interest instead? So private equity firms pivoted. They started lending directly to companies banks no longer wanted to touch. This market became known as private credit. The returns were attractive, the loans were flexible, the regulation was lighter. There was only one problem. Private equity didn't have what banks had: permanent money. Banks are built on deposits, checking accounts, savings accounts, money that tends to stay put even during stress. That stability allows banks to lend aggressively.
Private equity capital is different. Investors can pull out. Funds have expiration dates. Capital must be raised again and again. That's not a stable foundation for a lending empire. So private equity faced a question that would change modern finance. How do you build a bank without being a bank? The answer came from an unexpected place: insurance. Life insurance companies already had exactly what private equity lacked: long-term, locked-in capital. When someone buys an annuity or a life insurance policy, they aren't making a short-term investment. They are locking their money away for decades. Pulling it out early usually comes with severe penalties. From the policyholder's perspective, this feels restrictive. From a financier's perspective, it's perfection. Billions of dollars, locked in place, predictable cash flows, wrapped in public trust. And critically, insurance companies were not regulated like banks. No Federal Reserve oversight, no FDIC requirements, no liquidity stress tests designed for runs. They were regulated, but for a different world, a world where insurers bought government bonds and waited patiently. Private equity realized something subtle but powerful. An insurance company already performs the core function of a bank. It collects money, it invests that money, it earns the difference between what it promises and what it earns. The only thing missing was intent. Once private equity firms started acquiring insurance companies, everything changed. From the outside, very little looked different. The logos stayed familiar. The policy documents looked the same. The marketing still emphasized safety and stability. But behind the scenes, the incentives shifted. Insurance premiums were no longer just premiums. They became funding. Instead of investing primarily in government bonds, insurance portfolios began filling with private credit loans, structured debt, and complex financial products. The same assets banks had been pushed away from. The logic was simple. Promise retirees a modest return. Use their money to fund higher yield loans. Keep the spread. This is exactly how banking works, but without banking rules. What emerged wasn't innovation, it was imitation, carefully disguised. The insurance company became the front. Behind it, a shadow bank quietly took shape. This transformation didn't trigger panic. There were no flashing red lights, no sudden collapses, no obvious villains. In fact, everything looked better. Returns improved, profits grew, stock prices rose. Retirees were happy, investors were thrilled, regulators saw no immediate crisis. And complexity did the rest. Insurance accounting is dense. Reinsurance structures are opaque. Private credit doesn't trade publicly. Very few people could see the entire system at once, and those who benefited had no incentive to simplify it. But financial history has a rule it enforces relentlessly. When returns look smooth and effortless, risk is being hidden somewhere. And in this case, it wasn't just hidden, it was relocated. Insurance carries moral weight. It represents protection, responsibility, trust. People believe in insurance in a way they do not believe in banks or hedge funds. That belief became armor. Because as long as insurance felt boring, no one asked uncomfortable questions about what sat behind the guarantees. But the guarantees didn't disappear.
They stayed exactly the same. What changed was what backed them. To understand how this system actually works and why it's far more fragile than it appears, we have to follow the money beyond Wall Street. Not to Washington, not to New York, but to a small island in the Atlantic Ocean. An island where rules are different, accounting is flexible, and risk quietly changes its address. Bermuda. When most people think about offshore finance, they imagine tax evasion, shell companies, and hidden bank accounts. That picture is outdated. Modern offshore finance isn't about hiding money, it's about changing rules. And nowhere is that more important to the shadow banking system than Bermuda. At first glance, Bermuda seems irrelevant, a small island in the Atlantic, better known for beaches and tourism than global finance. But in the insurance world, Bermuda plays a very specific role. It is where risk goes to become cheaper. Not safer, just cheaper. Insurance is regulated differently from banking in the United States. Instead of a single federal regulator, oversight is fragmented across state insurance commissions. Each state focuses on the company domiciled within its borders. This worked well when insurance companies were simple, but it breaks down in a world of subsidiaries, offshore entities, and global capital flows. Bermuda recognized this opportunity decades ago. It built a regulatory framework designed to attract insurance and reinsurance companies, not by removing rules entirely, but by offering flexibility, especially around how risk is measured and how much capital must be held against future promises.
That difference, small on paper, changes everything. In its original form, reinsurance is sensible. An insurance company takes on risk, hurricanes, mortality, disasters. To avoid a single catastrophic event wiping it out, it buys insurance for itself. That insurance is called reinsurance. Risk gets spread. The system becomes more resilient. No single failure takes down the whole structure. That's the theory. But in the shadow banking era, reinsurance evolved into something else, a tool not to spread risk, but to move it. Here's the simplified version of how the system works. An insurance company in the United States sells annuities or life insurance policies. Those policies come with strict requirements. The insurer must hold a large capital buffer, real money set aside, to ensure it can pay claims even in bad economic conditions. That capital is safety. It's also unproductive. From a private equity perspective, capital sitting idle is a problem. So the insurer signs a reinsurance agreement with an offshore affiliate, often located in Bermuda. On paper, the offshore company now assumes responsibility for the policies. The promises to retirees haven't disappeared. They've just moved. And when they move, the rules change. In the United States, insurance regulators are deliberately conservative. They force companies to assume low investment returns and demand thick capital cushions. They assume things will go wrong. Bermuda takes a different approach. Its regulatory framework allows insurers to use higher assumed returns when calculating how much capital they need today to pay obligations far into the future.
This difference sounds technical. It isn't. If you assume you can earn 8% instead of 4% over time, the amount of money you need today drops dramatically. Nothing about the actual risk changed. No cash was created, no debt was reduced, but suddenly capital is released. That released capital doesn't stay idle. It moves upstream. Dividends to the parent company, fuel for acquisitions, funding for more lending. This process is known as capital efficiency. A more honest description would be leverage disguised as optimization. On its own, this maneuver looks clever. Across hundreds of billions of dollars, it becomes systemic. Each reinsurance transaction reduces capital buffers slightly. Each reduction increases leverage quietly. Each step makes the system more sensitive to stress. And because this happens gradually, no single regulator sees the full picture. The U.S. regulator sees a compliant insurer. The Bermuda regulator sees a well-capitalized reinsurer. The asset manager sees higher returns. No one sees the entire machine. That's the blind spot. Capital relief is only half the story. The bigger change happens on the asset side of the balance sheet. U.S. regulators discourage insurers from holding too many complex, illiquid assets, private loans, structured products, things that can't be sold quickly. These assets require more capital. They raise red flags. They invite scrutiny. Bermuda is more accommodating, which creates a feedback loop. Private equity firms originate loans. Those loans don't fit neatly inside U.S. insurance rules, so liabilities move offshore, and offshore entities buy the loans. Same parent, same incentives, no independent negotiation. Risk doesn't leave the system, it just moves somewhere quieter. In traditional reinsurance, the reinsurer is independent. It prices risk carefully. If the deal doesn't make sense, it walks away. In the shadow banking model, the reinsurer is often owned by the same parent company as the insurer. There is no arm's length negotiation. There is no external discipline. The offshore entity exists to accept the risk. This matters because market discipline is what keeps systems honest. When it disappears, assumptions stretch. Private credit and structured assets don't trade on public markets. There is no daily price discovery. Their value is determined by models, assumptions about default rates, recoveries, and correlations. As long as nothing forces a sale, those models appear stable. This is the illusion. Risk doesn't look dangerous when it isn't moving, But finance doesn't break when prices fall. It breaks when liquidity vanishes. There is a mechanism designed to protect policyholders. If an offshore reinsurer gets into trouble, regulators can force the U.S. insurer to recapture the policies, bring the liabilities back under domestic oversight. On paper, this sounds reassuring. In reality, it's the most dangerous moment in the system. Because the capital that was released years earlier is gone, paid out, reinvested, leveraged again. When liabilities return, they come back heavier. The cushion is thinner. The margin for error is smaller. Safety was rented, not owned. This structure should feel familiar. In 2008, banks moved risk off balance sheet into special purpose vehicles. Those vehicles were supposed to isolate danger. Instead, they concentrated it.
When markets turned, the risk rushed back all at once. Balance sheets collapsed in days. The insurance shadow bank has its own version of that moment. It just hasn't happened yet. There was no obvious failure, no sudden losses, no public panic. Returns stayed high. Defaults stayed low. Models kept agreeing with optimism. And complexity did the rest. The system didn't look dangerous. It looked sophisticated. But sophistication doesn't remove risk. It redistributes it. So far, we've followed the money, from retirees to insurance companies to offshore reinsurance to regulatory blind spots. But we haven't looked closely at what sits inside those offshore balance sheets. Because when you do, something unsettling appears. Not innovation, not diversification, but debt, bundled, sliced, and engineered in a way that looks uncomfortably familiar. To understand the real danger, we need to examine what these insurers are actually buying with retirement savings. And that leads us to the heart of the shadow banking machine: private credit and collateralized loan obligations. To understand why this system is fragile, you have to understand what sits at the center of it: debt. Not the kind of debt most people imagine, not mortgages or credit cards or government bonds. This is corporate debt issued to companies that banks no longer trust enough to lend to directly. Private credit. Private credit didn't explode because it was safer than bank lending. It exploded because banks were no longer allowed to do this at scale. Regulations forced banks to reduce exposure to risky borrowers, highly leveraged companies, and opaque balance sheets. Private equity stepped into that gap. They offered loans when banks wouldn't. They charged higher interest. They accepted weaker protections. And they did it outside the traditional banking system. For years, this looked like a win-win. Companies got funding, investors got yield, and private equity firms collected fees. But private credit has a structural weakness that only appears under stress. It is illiquid. Public bonds trade every day. Prices move constantly. When risk rises, prices fall immediately. That's painful, but it's honest. The market forces recognition. Private credit doesn't work that way. These loans don't trade on exchanges. There's no live market price. Their value is estimated using models, assumptions about default rates, recovery values, and future cash flows. As long as borrowers keep paying, everything looks fine. As long as no one needs to sell, nothing breaks. This is how risk stays hidden. But insurance companies don't just hold private credit directly. They often hold something more complex: collateralized loan obligations, CLOs. Private equity firms lend to dozens or hundreds of companies. Those loans are pooled together. The pool is sliced into layers called tranches. Each tranche has a different claim on cash flows. The top tranches are labeled safe. The bottom tranches absorb losses. Ratings agencies assign grades based on models. On paper, this looks diversified. In reality, it's correlation disguised as complexity. The loans inside a CLO are often exposed to the same economic forces: rising interest rates, slowing growth, tightening credit. When conditions worsen, defaults don't happen one at a time. They cluster.
This is exactly what happened in 2008 with mortgage-backed securities. The structure is different, the asset class is different, the logic is the same. CLOs have performed well historically. That's the argument defenders always make, and it's true, so far. But performance during a long period of falling interest rates and abundant liquidity doesn't prove resilience. It proves compatibility with easy conditions. Most private credit loans today are floating rate. That means interest payments rise as rates rise. This protects lenders on paper. In reality, it strains borrowers. A company that could barely service debt at 4% struggles at 8%. At 10%, it breaks. Rising rates don't improve credit quality. They expose weakness. And because private credit borrowers are already highly leveraged, the margin for error is thin. Defaults don't need to explode. They only need to rise enough to break assumptions. The value of CLO tranches is not determined by daily trading. It's determined by models. Those models assume default rates stay within historical ranges, that recoveries remain predictable, that correlations remain low. But financial stress changes correlations. When the economy slows, weak companies fail together. Industries stumble together. Refinancing windows close together. This is when diversification stops working. And because prices don't adjust instantly, losses are recognized slowly until they're recognized all at once. This lag is dangerous. It creates the illusion of stability precisely when risk is increasing. Insurance companies promise long-term stability. That's their strength. But many products allow policyholders to exit early. Annuities can be surrendered. Policies can be cashed out. Penalties exist, but penalties don't stop fear. When interest rates rise sharply, people move money. When headlines turn dark, people seek safety. When one insurer shows stress, behavior spreads. This is how liquidity crises begin. The problem is simple. Liabilities can move faster than assets. Private loans cannot be sold quickly. CLO tranches cannot be liquidated easily. Models do not generate cash. Banks are designed for this problem. Insurance companies are not. Banks hold reserves. They undergo stress tests. They have access to central bank liquidity. Insurance companies don't. There is no lender of last resort for insurers. People assume that if an insurance company fails, the government will step in. That belief is incomplete. Insurance is backed by state guarantee funds, not federal programs. These funds are small, fragmented, and designed for isolated failures. They work when one regional insurer collapses quietly. They do not work in a systemic crisis. If a large private equity-backed insurer with hundreds of billions in liabilities fails, the math simply doesn't work. Coverage caps limit payouts. Delays are inevitable. Confidence evaporates. The guarantee system was never designed for this scale. This is the central moral hazard of the system. Private equity firms earn fees up front. Asset managers benefit from growth. Executives are rewarded for performance. Policyholders receive fixed promises. They don't share in the upside. They absorb the downside. And they don't get to opt out. Most retirees don't know their annuity is funding private credit. They don't know about offshore reinsurance.
They don't know how CLOs are structured. They see a brand, a rating, a guarantee. Trust replaces transparency. The system works best when nothing is tested. As long as defaults rise slowly, as long as exits are manageable, as long as no one is forced to sell. This is the waiting phase. Models still look reasonable. Returns still arrive. Regulators reassure. But financial systems don't fail because risks are unknown. They fail because risks are ignored until timing matters. Confidence doesn't collapse gradually. It breaks suddenly. The transformation of insurance into shadow banking didn't happen overnight. It happened through incentives, optimization, and drift. No single decision looks reckless. No single structure looks fraudulent. No single regulator feels responsible. That's what makes it dangerous. because when pressure arrives, there is no single lever to pull, only a system that assumed time would always be available, and time is the one variable finance never controls. The final weakness in the shadow banking system doesn't come from exotic derivatives or hidden loopholes. It comes from people. Every financial structure, no matter how complex, eventually depends on human behavior, confidence, fear, herd instincts. And when systems are built on assumptions about calm behavior, they tend to fail the moment emotions enter the equation. Insurance is no exception. In fact, insurance is uniquely vulnerable to shifts in confidence because it is built entirely on trust. Policyholders don't monitor balance sheets. They don't analyze asset quality. They don't track offshore subsidiaries. They assume the promise will be honored. And most of the time, that assumption holds until it doesn't. Insurance companies are not designed to handle rapid withdrawals. Their business model assumes patience, time, predictability. Premiums come in slowly. Claims go out slowly. Assets mature over decades. That works perfectly when behavior is calm. But modern insurance products quietly allow flexibility. Annuities can be surrendered. Policies can be cashed out early. Penalties exist, but penalties don't stop panic. When interest rates rise sharply, people notice. When markets wobble, people reassess. When one institution shows stress, people ask questions, and questions spread faster than capital. This is how a liquidity crisis begins, not with insolvency, with doubt. Liquidity crises don't require assets to be worthless. They only require assets to be slow. Private credit loans don't trade instantly. CLO tranches don't have deep, active markets. Offshore structures don't unwind overnight. But policyholder decisions can happen in days. This mismatch is the most dangerous feature of the system. Banks learned this lesson the hard way. That's why they hold reserves. That's why they submit to stress tests. That's why they have access to central bank liquidity. Insurance companies don't. There is no Federal Reserve window for insurers, no overnight liquidity line, no lender of last resort. When cash is needed, assets must be sold. And when assets can't be sold, promises come under pressure. At this point, people often assume the government will step in. That assumption feels reasonable, but it's wrong in important ways.
Insurance is not federally guaranteed. It is backed by state guarantee funds. These funds are fragmented, underfunded, and designed for isolated failures. They work when a small insurer collapses quietly. They fail when a giant collapses loudly. Coverage limits cap payouts. Payments can be delayed for years. And in a systemic event, surviving insurers are expected to fund the losses at the exact moment they are under stress themselves. The math doesn't work. The guarantee system was never built for a world where insurance companies function as shadow banks. This creates the final moral imbalance. The upside of the system belongs to asset managers. Fees are earned early. Bonuses are paid annually. Capital is extracted during good years. The downside arrives later. And it arrives somewhere else. Policyholders don't get upside participation. They get fixed promises, and fixed promises are fragile when backed by variable risk. This isn't a conspiracy. It's an incentive problem. When those who decide risk don't bear its full consequences, risk grows quietly. What makes this system especially dangerous is how ordinary it looks. There are no flashing warning signs, no speculative frenzy, no obvious bubbles. Everything is dressed in professionalism, in ratings, in regulatory language. Complexity becomes camouflage. And complexity discourages scrutiny. Most people don't question systems they don't understand, especially when those systems appear stable. That's how fragility hides. The transformation of insurance into shadow banking didn't require malice. It required drift. Low interest rates, pressure for returns, regulatory gaps, optimization culture. Each decision made sense in isolation. Together, they built something brittle. And brittle systems don't fail often, but when they do, they fail decisively. Financial history shows this pattern again and again. Risk doesn't disappear when you regulate it, it moves. After 2008, banks became fortresses. Capital rose, leverage fell, oversight increased, but finance adapted. Risk migrated to places no one feared, places associated with caution, with trust, with boredom. Insurance. That was the mistake. Insurance was supposed to be where risk went to die. Instead, it became where risk learned how to hide. Not loudly, not recklessly, but quietly, patiently, wrapped in long-term promises and institutional confidence. The shadow banking system doesn't announce itself, it waits, and whether it remains invisible or becomes impossible to ignore depends on the one force finance can never fully control: time. By the time financial risk becomes obvious, it's usually too late to avoid it. That's the lesson history keeps repeating. The most damaging financial systems aren't built on fraud or chaos. They're built on trust, on assumptions that feel reasonable for years, sometimes decades, until conditions change and those assumptions quietly break. The transformation of insurance into shadow banking fits that pattern perfectly. Nothing about it looks reckless, nothing about it feels urgent, nothing about it screams danger, and that's exactly why it matters. Insurance was trusted because it was boring, because it was slow, because it existed outside the noise of markets and speculation.
It was supposed to be the financial product you could stop thinking about. But the world changed. Low interest rates punished patience. Regulation redirected risk instead of removing it, and financial innovation optimized every spare inch of the system. Insurance didn't resist those pressures. It absorbed them. What once existed to reduce uncertainty began quietly absorbing it instead. That doesn't mean collapse is inevitable. It doesn't mean every insurer is unsafe. It doesn't mean every annuity is a ticking time bomb. But it does mean the old assumptions no longer hold. Boring no longer guarantees conservative. Complex no longer guarantees diversified. And regulated no longer guarantees protected in the way people expect. The real danger of the shadow banking system isn't that it will explode overnight. It's that it will fail politely, through delays, through limits, through explanations that sound reasonable until there aren't. Financial crises don't always arrive as panics. Sometimes they arrive as paperwork. And by the time people realize what changed, the choices are gone. This is why understanding systems matters more than predicting outcomes. You don't need to know exactly when stress will arrive. You only need to know where fragility lives. Because systems built on confidence rather than resilience tend to behave the same way when confidence breaks. They don't bend, they don't adapt, they transfer the cost. And that cost almost always lands on the people who were promised safety, not the ones who engineered performance. Insurance didn't become dangerous because someone wanted it to. It became dangerous because incentives drifted and no one stopped the drift. That's how most financial risk is created, quietly, legally, incrementally, until it isn't. If there's a lesson in all of this, it's not fear, it's awareness. Modern finance is no longer divided neatly into safe and risky. Those labels are marketing. Reality lives underneath them. And the systems that feel most stable are often the ones worth examining most closely. Because risk doesn't disappear when it's hidden. It waits. If you want to understand how power, money, and risk actually move beneath the surface of the financial system, stay curious. And if this kind of breakdown helps you see the world more clearly, you know what to do. I'll see you next time.